Hello, everybody. Thank you for joining us today. My name is Mona Riamesco, and I'm the Digital Marketing Manager here at Surecom. We have over 100 people registered for this session from literally all the corners of the globe. So welcome to all of you from wherever you are. Our webinar today, in collaboration with ESG rating agency Scope, is going to focus on trade-based ESG scoring. We're going to explore how the current trade-based ESG landscape looks and why it's important to take action. But before I hand it over to our speakers, Bernard Bartels, Group Managing Director at Scope Agency, and Enno Weitzel, Surecom's SV of Strategy, Digitization and Business Development, I have a couple of housekeeping points that I'd like to share. You're all automatically muted, but you're welcome and encouraged to ask questions via the Q&A. And the session will be recorded and will be made available after the webinar. But without any further ado, I hand it over to you, Enno.
Thank you very much. I do hope I am visible. And if so, all welcome. And now I can see me, that's a good sign. So welcome everyone to our webinar on ESG. Why are we today talking about ESG? In September last year, we from Surecom conducted the first ever global pilot to compute an ESG score for every single trade finance transaction. And we did this applying the ICC Sustainable Trade Framework. So why the ICC? Well, the International Chamber of Commerce is the one body that can actually create and shape a framework that could be applicable to all businesses around the world. So as with all our innovations, we collaborated very closely with our customers, both on the banking side and on the corporate side. And maybe just to quickly let you know what we did in that framework, let me share my screen so that you can get a glimpse of the scope of that ESG scoring pilot that we did. So as you can see, the ICC has created a framework that allows to compute an ESG score per single transaction. Now, what do you need to do to come up with such an ESG score? You need information on the buyer and the seller of the transaction. You need information about the goods description and the shipment route. Now, once you have that, two scores will be computed. One on the environmental impact and the other on the socioeconomic impact. And once you've done that, you will actually result in a score. Now, and for the very initial phase of what the ICC is suggesting, a simple yes/no was basically sufficient, yet we already jumped to the second step where we were able to actually give a more granular result in terms of, is that transaction meeting minimum criteria, or is the harm that's been done with that transaction outweighing the benefits? Now, without going into too much detail initially, let me share the initial feedback that we got. Both banks and corporates, liked to collaborate and engage on ESG and improving the sustainability. However, there were concerns on how such framework, as you can see in the screen, would connect to the work on ESG that the companies, both corporates and banks, are already doing. And there was a little uncertainty as to where the market and eventually the regulators would turn to. And these, say, concerns, uncertainties, doubts, we want to pick up today and in the webinar focus on what's the difference between ESG and sustainability? Because sometimes these words are used, but it's not exactly clear what the one is versus what the other means. Once we've delved into that, we will look into where the trade finance situation is today and then discuss what to be done next. And in order to provide an insight and first information onto what's the difference between ESG and sustainability, I'm more than happy to hand over to Bernard, who will introduce us into the topic, and then we'll move to the status quo of the ESG within trade finance. Bernard, over to you.
Thank you very much, Enno, and also welcome again on behalf of Scope ESG. Let me also share my screen so that you can see what I would like to introduce you to. So let me follow up directly on Enno's remarks. As you know, these days it becomes more and more visible that ESG has been misunderstood actually by many in recent years. So today, the focus of companies relies primarily on ESG risks. So what you see on the left-hand side. But that is how do environmental regulation, remuneration, or governance practices expose you to financial risk as a company. And that is what people understand as financial materiality or enterprise value orientation. Now, this outside-in definition, as you see on the left-hand side, is primarily applied today by popular ESG providers, and it's also very much implemented in corporate sustainability disclosures or non-financial disclosures. However, this dimension largely ignores the negative impacts on environmental and/or social capital that are often not reflected in ESG ratings because the true costs to society is not internalized by the entity producing the damage. And a simple example here is the gap, for instance, between carbon taxes and the social cost of carbon, where the social cost of carbon ranges maybe somewhere in between 180 to 200 US dollar per produced ton, while carbon taxation ranges rather around 40. Some countries have maybe a tax right now introduced of more closer to 100, but it's also only applicable to certain industries, and it's not a global tax. So in other words, we are still far away from a situation where impact, so the inside out definition, matches and is kind of common sense with the outside in definition. There's still a big gap. Now, the inside-out perspective, so the right-hand side, this explicitly focuses on the negative and positive values for society created by a company. And the main difficulty here, of course, lies in the quantification and measurement of those impacts. For instance, everyone is aware of child labor practices in many parts of the world, but we will not find any company statement which defines the extent of the individual exposure to such practices as of now. And to illustrate once more this difference, let me go one slide further between risk and impact. And you see the two world maps here. So the map on the upper panel shows you the distribution of climate risks across countries. And the global south is the most exposed region, clearly, with expected losses from natural hazard, but also chronic temperature increases at high temperature levels already today. While the map in the lower panel shows the distribution of impacts on climate. So who produces the global warming? And this is proxied by per capita consumption of emissions. And obviously, the two charts fall apart, right? So countries that are most exposed to climate-related hazards contribute the least to global warming. And that's where we see clearly why there is such a big gap between what we consider to be risk or impact. So when we go back to what is the definition of sustainability, probably most of us would agree that the value that you produce for wider society is something that you can define as sustainability. The problem is it's not very tangible. While the ESG risks that everybody is implementing today, like the remuneration of their own employees, the treatment of gender discrimination in rules and in corporate governance documents, that is well implemented, that is well noted and tangible. But the question is it really what defines the sustainability of a company? So now what has been done, and I think this is another very important area that we need to mention. Well, we see that the implementation of the EU's sustainable finance agenda addresses the above mentioned misunderstanding. So we are now facing a new regulatory framework for financial markets and also the corporates. And this is done with the EU taxonomy, left-hand side, the SFDR and the CSRD. All of them incorporate impact from different angles. So while the EU taxonomy focuses primarily on the environmental impact of a product, so enabling carbon reduction or transitional activities with reduced carbon intensities, such as through solar panels or through a very sustainable production of cement. Then you have, on the other hand, SFDR and CSRD, which complement that downstream perspective, product related, with the upstream perspective. That means, how are you exposed to risks in your supply chain? And those can be socially related through exposure to child labor, but also environmentally related when it comes to water consumption, land use, or carbon. Now, while the SFDR and the CSRD complement the downstream with the supply chain elements, they are not yet completed. So we are not yet in a phase where we can say, these are the new standard, this is the new standard, this is what you have to disclose. The EFRAG, so the organization at the EU Commission that is producing those standards, they are still working on sector-specific criteria today, but shortly we will know, and then it will be very fascinating to see what the companies will have to do. Right, but it's certainly going to be very much upstream and downstream related. And in the same vein, we also see that ISSB, so the new international disclosure standards on non-financial reporting, will also adopt certain elements of the CSRD. That means we will also have supply chain disclosures, not only across European corporates, but also beyond that. And the latest we heard from the ISSB is that there will be an implementation of those supply chain related standards globally, certainly maybe not to the same extent and level of depth as in Europe, but also with this clear focus. And that's very important because it is certainly establishing a new era of sustainability reporting. And with those introductory remarks, I hand back to Anna. Thank you.
Well, thank you, Bernhard, for that very interesting introduction to the topic. So just summarizing the difference between what banks and corporates today most often do when they are active in ESG is that assessing the risks that they are exposed to when it comes to environmental or social risks. So for example, also the European Central Bank is asking the banks to assess their credit risk portfolio or their credit portfolio on ESG risks. Now, what we did with the ESG pilot that the ICC was promoting, we were looking at the impact of the own activities. So that outbound view to say, what I'm doing, what is the impact that my doing has on the environment? So it enables to look at each transaction individually. It's based on the information that is inherent in each transaction, and it enables to get a new perspective on the own effect on environment, socioeconomic, and the governmental impact. Now, let me share a little bit on what we found out. Sorry, where's that? Here we go. What we found out during the pilot. And the one is we were able to actually apply that information. Yet there was some element of data that we still needed because the goods description is not codified. Sometimes you simply have spare parts for a certain type of material and that can't be rated properly. And there's also a certain element of greenwashing because in the end, the question is what actually will classify as being sufficient or having a positive impact. But let me talk a little bit, sorry, going back in the presentation, let me talk a little bit about what also Bernhard mentioned, the way how to assess whether a transaction actually is having a positive impact or not, and how you could apply that impact notion to a single transaction in trade finance. Now, the key is to make use of the so-called United Nations Sustainable Development Goals. Bernard, you were mentioning the topic of child labor, or let's use the example of no poverty, right? Which is a United Nations sustainable goal. Now, what we did together with Scope is we try to rate each dimension, so the goods description, the seller, the buyer, and the means of transport, by that United Nations Sustainable Development Goals. And while no poverty as a goal may be a little tricky to apply to the means of transport, there are proxies that can be used. And one of the proxies could be, is the shipping company paying minimum wages applicable to these regions to the crews of the ships? So you could take that information, which is publicly available, and have a proxy information for whether using that ship or engaging with that shipping line is actually supporting the goal of no poverty, and thus has a positive impact. And this is the way what we applied in doing that pilot, trying to really bring this notion of measuring the impact to you, and you being everyone that is planning to apply that ESG rating per transaction, and to make it workable. So this is just the outlining again that what we try to do with that, turning from that inside view of that financial risk assessment towards an outbound view to say, how am I impacting the environment with what I'm doing? It's not rocket science, so to say, because you can apply available measures and will have a far greater transparency on your own activities. Now, you may question how would that be applied in a greater scale? And eventually, let me hand back again to, stop the sharing. Let me hand back to Bernard, who will introduce the idea of applying that notion of supply chain or value chain assessment to the trade finance space. Bernard, to you.
Thank you again. And let me share my screen. So I hope you will see it again. Indeed, I know, as you mentioned, what we consider to be of utmost importance going forward is to better understand the company's business model in general as a focus not only on what are you producing in your own location, but also what are you importing, from whom do you import, and where does potentially your export move towards final consumption, and in which locations where it is finally consumed. And these elements are summarized as value chain assessments ultimately. And when you look at trade finance, it becomes, of course, even more relevant to have that perspective than if you even only look at one particular company, because then you have to assess ESG aspects across globally dispersed value chains in production and transport. And that, of course, also exposes you to some information requirements that you have, right? So first, there's limited data available on remote located producers, and often just no information on the further supply chain of a local exporting firm. Second, you have multiple parties being involved in the transaction. So you have to have information about the environmental, the social costs or contributions of those relevant parties. And finally, you need to structure that information. So you want to know which of those impacts are material. So is it important for me to know what the water consumption is of a ship that is transporting the good from one location to another, or shall I rather focus on the water consumption in the textile sector that is exporting or shipping the textiles from one location to the other? So those are the important things that you need to take into account when you assess a trade transaction impact. So it has all those multiple facets, and maybe one facet I haven't yet mentioned is it does also make a difference on whether you're transporting an electric vehicle from Germany to Sweden or if you transport it from Germany to China, because the electricity mix that is used in China to run the car over its life cycle is a different one than the electricity mix in Sweden. So ultimately, you would have a different carbon intensity of the good that you transport over the life cycle. This is something what we call downstream, right? So this would be a typical example for a downstream assessment related to the commodities or goods that you transport from one to the other location. Now, this is one example, but you could also go one step further and think about typically transported commodities that are transported before being finally compiled or manufactured. So this schematic overview that you see here can provide you with a rationale on the materiality assessments in trade finance transactions. So when thinking about typically traded commodities, if you consider textiles, chemicals, metals, the most relevant impacts usually appear in the first sectors. That means in agriculture, in mining, but also then in the material sector, so in the processing of basic metals, aluminum production, when it comes to processing chemicals, that these are CO2 intensive, these are maybe also related to hazard related works, and that occurs, of course, as well in the textile sector or with plastic production. So at the same time, the problem is that the value added that is created in those sectors is relatively minor or limited compared to other sectors that follow later. So in the end, you're not only looking at the absolute emissions or impacts that occur in that sector, you also consider the value that is created in the specific sector. And the value added is small in the beginning, and it only increases as you go along. So basically, when you are reaching the manufacturing state, then this is where much of value added is produced, but maybe not that much of impact anymore. And you see that when you look at the current balance sheets of many European listed companies, they are Scope 1 and 2 emissions. So the greenhouse gas emissions that they produce directly in their own factories, these are very small. And they become smaller and smaller over time, and they will be shortly by net zero. While the embodied emissions in the inputs they are using for the production, those remain high and are more unlikely to change quickly. And this is based on the fact that you're actually having this reliance on supply chains where you import let's say, embodied emission in electrical equipment that was produced originally in China. And these are aspects and issues that we consider in a trade finance transaction, as we also do when we assess a company. But again, in a trade finance transaction, it's much more visible and much more important to take note of those. So in the end, what we will have is we observe high intensities in the sector production at the beginning of a supply chain. You will at some stage have a transportation, and then maybe another manufacturing, or maybe ultimately you directly refer to the final goods, or you transport directly to final goods consumption. And this is where downstream then comes also into play, where you think about what would be the consumed emission over the life cycle from that good. And here we can talk about electrical components, but also we can talk about different types of goods where it depends on how is usually the plastic waste used after consumption. So after the end of life, the product, how is it recycled? Is it going into incineration, or what happens after the life? So all of these aspects are considered. But we have, of course, to admit that it's very hard to do that on a company level, because we often are looking at very small companies. We are often looking at very small suppliers which have no non-financial reporting that allows you to make those to assess those impacts, which is why we are currently also left with sector-specific values. So we do know something about the agricultural impact from CO2 in Vietnam, in the textile sector, in the agricultural sector, and in different production activities and so on. So this is something we know and that we can exploit. And this is the way one can assess, at least in the beginning, also the impact of a trade transaction. And with that, I hand back to you. Thank you.
Well, thanks, Bernhard, for that very interesting. Maybe you can keep the slide because I really think that shows the necessity of applying that outbound view. So that impact view to the supply chain. And basically, that's what we're talking about when we say trade or transaction-specific ESG scoring, because it's not just one step, it's a chain, right? And so going back to the idea of that webinar today, to shed a little bit of light onto the difference between what many companies and definitely almost all banks are already doing when it comes to ESG, which is assessing the financial risk they are exposed to when it comes to environmental risk or socioeconomic risks. And yet a different view, which is what's my impact that I have through my activities on the, say, the world, both in terms of environmental impact, in terms of socioeconomic impact, the examples of the child labor or minimum wages that we were discussing. And the necessity to not only look into my front garden, but to look down my buying chain, my purchasing chain, and up my supply chain. So where am I selling to and where am I sourcing from, right? And now you may question, so what to do with it, right? And when to start? And should I act now or should I wait until, for example, the framework from the ICC is completed? And I think what, and that's why I really like that overview also, Bernhard, is there is already information available and there is a need to act, no doubt, right? If we simply continue acting the way we act today, we have a relatively clear picture on where that will lead to, and that's not very preferable. So we all should act, or we ought to act. It may not have an immediate direct return on investment business case, but the investment is the positive impact that we may have. And maybe just the last point from my end, there are use cases that we also found out during applying the ICC pilot and computing that score, because, for example, the choice of the ship, right, will have an immediate impact on the overall rating of your impact, because for the shipping the same good with the same production as Bernhard, you said, embodied CO2 or carbon emission footprint, and ship it to the very same location may have a different outcome when you ship with a good versus a not that good ship, or a ship that has a net negative impact versus a ship that net adds value. And that can be from applying minimum wages or having a certain level of green energy for the fueling of the ship as compared to a ship that is burning crude oil, right? So there are use cases that today everyone can apply, and therefore I think last point from my end is that there's a definite case to act, and the time is now, because this is a journey that we're on to change the way we're behaving. And as every long journey, right, you need to start. And with that, looking at the time, it's exactly past, at least looking at my watch. So I should say, let's open the audience, the floor to the audience, and see if there's any questions that Bernhard and myself would be happy to take.
Hi, Anna. There's actually a few questions from the audience. The first one is, can you explain a bit more about how Scope obtains its data and scores, and how does this data then get fed into Revo?
Yes, I think that's a question for me. Thank you very much for this one. I think I pointed to it already in my last sentences, but indeed I didn't really put it into context. So first of all, I think what is really important to note, and it's good that we have this slide here because it shows it pretty nicely. What we do look at is the emissions or number of child working hours, or the amount of air pollution and so on, related to a sectoral activity in a country. And here we are exploiting the available data that we find on sector level across a wide set of economies. We include here the complete OECD, so there are more than 60 countries. And then we look across 45 sectors within these countries to better understand to what extent does an impact affect the sector. Now, having done this, it's still important to ask, okay, so what do you do with an absolute emissions level of emissions of, let's say, 100 million tons produced in one sector? Is it high? Is it low? How do you compare? How do you apply it to a company? Now, what we do is, first of all, that we speak about intensities. So we define intensities as the production scaled by the revenues in the sector. So what is the amount of production in that sector that is being sold, and how does this relate to the relevant impact, again, be it child labor or whatever. And then we look at the so-called input-output tables to define where does the output of that sector flow. Does it flow to a sector, fashion in Germany? Does it flow to fashion in Sweden? Or where does it flow? To better identify what is the impact of a company that is located in that sector, in that country, and that is importing those goods. Now, that's one of the ways we are doing it. And then, on the other hand, what we also would like to know better is, how is one particular company exposed to such impacts? And that is where it becomes a bit more complicated, because we often, as I mentioned before, do not know what the true impact of the company is. And this is why we assess a company's material impacts by looking at their sectoral activities. So which are the business segment in which the company is active, and how many revenues does the company generate within these segments? And where are the fixed assets located? So where does the company has actually its production facilities? And with that information, we identify the direct impact of the company that is related to its own operations in the sector that it is involved in, operating in. And then from that, we also infer to indirect impacts that are coming from the input-output tables, where we observe, okay, Adidas is related to child labor in India because it is on average importing a certain amount of value added from a sector in India that is related to an extent of X to child labor. So basically what we are doing is we are approximating a company's impact through its locations and through its sectoral activities. That's the first step of analysis. Of course, you can go no further and say, okay, well, does the company maybe report some information that mitigates this impact that we assess? And this can be the case. There are, for instance, auto manufacturers that claim they are not importing certain rare earths from, let's say, regions like Congo. So they are excluding certain regions in their supply chain. And that can be supportive information to better understand what is the true impact of the company. Now, having said this, we are currently still in a situation where very few companies report in detail on their impacts. So we are currently rather focusing on assessing the materiality of those impacts. And this is done by monetization. So here we also try to better understand to what extent is it a problem for you that you may be exposed to some child labor relative to being exposed to some CO2 emissions. So we are actually assigning different prices to those impacts to have a better feeling for the size for the relevance of the impact to society, which is again reflecting the impact dimension, right? So the inside out dimension. And that's the way we identify impact in the first place. on companies, but also on country level. So we are not only able to assess this on company level, of course, we are also able to easily assess that on company level, where we offer both dimensions, the production dimension as well as the consumption dimension. So we entail both in order to make sure that it is not only reflected how CO2 intensive you are in your production at home, but also how many emissions your population is consuming per capita.
And maybe to the second part of the question, being aware that the data availability still has some gaps, we use the collaborative nature of the Revo platform to enable these, say, smaller companies to also provide input into that equation. And by that, over time, we aim to improve the availability of data. Just to, Monnery, close on the second part of the question of how Revo feeds into that.
I think next question is links with your answer, Anna, and that's directed to you. What is the pricing model for Revo? Is it flexible? What does the onboarding process look like? Can it be deployed as a standalone solution? And how easy it is to integrate with other solutions like ERPs, for example?
That's a raft of questions to it. So the ESG scoring will be part of the available subscription plans on Revo. And the data that you need, for example, to feed into the buyer supplier, the goods description, can easily be collected from the ERP system, since Revo is a cloud-based solution that has open APIs. Any ERP system basically can easily be connected to it, be it an SAP, be it an Oracle, be it Microsoft. It's really no limitation to it. And that's how we want to foster the seamless nature of the trade that we're supporting with and through Revo, so that anyone, and really seriously anyone that is doing transactions on Revo, can plug in their data, their raw data that they have, and can plug in data from third parties like Scope Group to also enrich the user experience that you have with the transaction that you're doing on Revo. If that, in short, hopefully answers the question.
Excellent. We've got just one more question, and I think that we can wrap up with the final one. How do you recommend I set about obtaining budget for a trade-based ESG program or a broader digital trade finance program in general?
That's a very interesting question, how to obtain budget for that. So looking at the companies that we have engaged with during our pilot, these are all companies that also very clearly stated that ESG is on the agenda. Now in various shades of gray, right? But it is on the agenda. So typically, it appears to be that these companies do allocate resources to improving the ESG risk or impact, depending on where on the journey they are. And now, without being in a position to provide outside-in guidance, it appears to be easiest to tap these type of resources to engage also in a trade transaction-based scoring. But again, I would expect it would be a very company individual situation, and I don't dare to provide a one-size-fits-all answer to that.
Great. We've got a few more questions, but I guess you can just reply to our attendees directly after the webinar because we're running out of time. So thank you both for this time, and I hope that all of you who attended found the webinar insightful. If you have any further questions, don't hesitate to reach out at marketing@surecomp.com or visit our website, surecomp.com, just to find out our digital trade solutions. Thank you, and have a good rest of your day. Bye-bye.
Thank you. Bye-bye.